Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. We haven't had him on in a while, but I definitely want to have him back because he's broken some very important stories in the gold community in the last year or so, and we're here to have him talk about Europe. So thank you for joining us again, Alasdair Macleod, who's head of research at Gold Money.
That's my pleasure, Jason.
Yes, thank you, Alasdair. Now, in terms of what's going on in Europe, we have the ECB. They haven't done a real QE yet because the Fed has basically done a backdoor bailout, right, of European banks. The Fed has printed the money for them, and then the ECB has drawn that with currency swaps and things, and we have the stuff that's gone on in Belgium with the purchasing of that. What's your opinion of this negative interest rates by ECB? Is this the Keynesian endgame?
Well, I think my reaction is that there are some very frightened people in the ECB. They see the threat of deflation, and there is no doubt that to a Keynesian and a monetarist, the threat of deflation is the most terrifying thing. And I think that they're trying to head this off at the pass. Not only is it negative interest rates, but they're saying to the banks, we will lend you money for up to 4 years at 0.25%. You know, now for goodness sake, go and borrow it and then lend it on to someone. So I think there's some very, very frightened people, because what all central bankers have applied the Keynesian medicine for the last 5 years, ever since the Lehman crisis, and it patently hasn't worked. And if you look at the United States for now, I mean, this wonderful recovery we were meant to be having in 2000. I mean, it's no longer a question of the weather in the first quarter. Even the IMF is now downgrading growth prospects in the US in the second quarter and for the rest of this year. So central bank medicine has patently failed, and I think they're too frightened even to pursue the Krugman approach of, the trouble is they just haven't done enough. I mean, which is absolutely crazy. I mean, it's rather like telling someone that, if your wife doesn't obey you, it's because you're not beating her enough. I mean, it's complete nonsense. So we have this situation, Jason, where I basically think they are terrified. And the reason they're going to these lengths is a measure of that terror.
Well, we always see, though, that the Keynesians are always going to be afraid of deflation because they're not seeing the credit growth, right? The Keynesians need that lending and spending. They need to see the consumers spend money they don't have. They need to see the banks give out loans to almost anyone with a pulse, basically. And we're here at the stage where the real economy, people don't really want to borrow, especially here in I can't speak for Europe because I don't live in Europe and I'm not a European expert, but here in the U.S. at least, there's not a lot of people who want to borrow. I mean, there are some small businesses who do, but the credit standards now for banks are enormous. So the interest rates for small businesses are very high who want to borrow. There's a lot of high standards now. They're not giving out loans to just anyone, and the terms are not very good. And then on top of that, in the real economy, there's not a lot of growth in many sectors. The consumer is basically tapped out here in the U.S. In fact, I think we're going to see a lot of failures by a lot of casual dining restaurants here in the U.S. It's something that the mainstream media is not covering yet, but you're starting to see an enormous amount of store closings in retail and malls and also like in restaurants. So it's just amazing, though, that we're still talking about Keynes, 100+ years later, and all of the things that he wrote about, like wasn't his main prescription for when there was a bust after a boom, it was start lowering interest rates, change savers' liquidity preferences, right, because they're evil hoarders. And he considered, he basically wrote the prescription. He was like, we can just create more currency units via inflation or quantitative easing. He didn't call it quantitative easing back then, but he was like, we have to change their liquidity preferences.
Yes. You raised so many issues there. I think the first one, if I can tackle it, is the question of banks not willing to lend or borrowers not willing to borrow. It's more or less the same over here, Jason. I think that, the people who want to borrow money, the banks wouldn't want to lend to. And the banks have also got a priority, and that is to rebuild their capital base. And this is something that is facilitated to a degree by the Basel III rules, which basically means that they can lend money to a government, and it doesn't matter whether it's the Spanish government or the German government or whatever, without having a haircut. So, and they know they've got a sort of an ECB put, and that's why Spanish debt is yielding, 10-year debt is yielding less than 3%. The distortions in the market are absolutely enormous. So I would like to make a general point that when markets are very distorted, then they just don't function properly. And the idea that the people are going to act as you might expect them to act if you're a Keynesian economist is complete hogwash. They are actually, you cannot calculate anything. When interest rates are zero or a minus figure, when you don't know what the value of a euro is going to be in a year's time or 10 years' time, if you're thinking of building a new car plant or investing in extra production or whatever, it really is an impossible situation trying to manage an economy the way the central banks are doing it. And unfortunately, they're finding that out. If I can come on to Keynes, Keynes basically ditched the law of markets in about 1932. His lectures started talking about things like effective demand and stimulating demand and so on. In other words, untying demand from production. He was because Say's law, which is the law of the markets, basically says that the only reason, Jason, that you and I go out to try and earn some money is so that we can spend it. And within that context, obviously, we're going to save. Now, that's deferred spending. And those savings are taken, through the financial system and used by businesses to invest in future production. So you've got your deferred savings and future production, which sort of broadly should match, and the rate at which savings is attracted out of me and you is a function of market demand for those savings and the supply of those savings, and that gives you a price and interest rate. So that gives you the context, if you like, for negative interest rates. I mean, they're complete, they just screw up that process completely. But once Keynes had divorced in his own mind demand from, supply in the sense of the supply of goods, the manufacture of goods, and the provision of services from consumption, then he's all about saying, well, we don't need savers anymore. Saving is a pain in the backside. It costs the economy. We need consumption. So the easiest way to bolster consumption, if there is not enough consumption, is to dig into the savings, and that's what we should encourage people to do. So it was really in 1932 he threw over the law of the markets, and that, of course, led to his definitive work, if you like, in Keynesian terms, which was his general theory. Before that, I would say that he was a lot more reasoned in what he wrote. I mean, if you read his Tract on Monetary Reform, for example, that was a far more reasoned book. Though even then he was putting up straw men, like on the subject of deflation. I seem to recall that he was writing about the deflation in Italy at the time and how the Italians, this was after the First World War, were following a deliberately deflationary policy of raising the value of the lira. And he rather criticized that approach by taking the extreme example. I mean, what happens if the lira doubles in a year, sort of thing? That's going to have the following nasty effects. But we're not talking, the Italians weren't talking about that. They were talking about having, a sort of a relatively healthy currency. All right, there was a bit of, macho approach in it, but he was sort of even then producing straw men arguments, things to sort of, which you had to knock down. But otherwise, by an ordinary person looking at it, they would think, well, yes, he's got a point. But he hasn't got a point, because that isn't exactly what was going on.
Yeah, I noticed those types of arguments throughout the general theory, that he would bring up these really basic examples that would really not happen in real life. And he just seemed to not it seemed to me he hadn't read von Mises or Hayek or even really Irving Fisher for the most part at the time, because those are some of the men who had produced some of the greatest, economic writings at his time, his best contemporaries, and he just seemed to basically ignore their arguments. And he just went, right back basically to Ricardo. That's what Henry Hazlitt was saying. I read Failure of the New Economics, which is where Hazlitt goes line by line through it. I thought that's a very interesting way to go through the book, because it's just too much other gobbledygook for it. But in terms of the inflation there, like he said, he just basically seemed to think that the banks, giving out loans and credit growth and things like that could replace the savings of people, and that would be okay for the economy. But then he said he hated speculators, which is even more ridiculous, because the businessman and the entrepreneur, when Steve Jobs was coming out, with new products like the iPad or the iPhone or the iPod, the products like that, he was a speculator too. I mean, they don't know if those products are going to work. They have to test it in the market, right?
Yeah, exactly. I mean, you can't. I think a more general point on that is that we all, I think, take the view that someone who produces something which we actually want to buy, whether it's an iPad or, I don't know, a bagless Hoover. We've got a guy called Dyson who invented the bagless Hoover.
That's a great story.
Exactly.
He took that to all the big guys, and they turned him down, and then I think he's going to end up being bigger than them, right?
Now, I would suggest that no reasonable person would take the view that someone like Dyson or Jobs or even Gates should be deprived of what they have made out of being successful, providing something we actually want and use. Now, I think that's rather different from the straw men who are so frequently offered, like bankers, who seem to make money out of nothing, providing nothing we want. You go along to the bank to borrow money, they refuse to lend it to you, and this guy's making absolutely bloody millions. And he's making millions actually because he's been granted a license by government to do that, to do things which, if you or I did it without a license, would actually be, under any legal system, fraud.
Counterfeiting.
Yeah, exactly. Well, it's the production of money out of nothing. And not only that, but to take someone's deposits and then to use them as if they were your own, which is what banks are licensed to do. And so there is this unholy alliance between industry, if you like, in this particular case we're talking about banks, and government. And that is actually the bit that is wrong. That is where, if you like, the sort of the morality of the whole situation is open to question. And I think we need to make that absolutely clear. I think we can all agree that the Dysons of this world and the Jobs of this world deserve what they make because they actually do it out of their own ability, and they do it providing something we need. As for the rest, then the system actually does need changing.
Yeah, I would agree that the system definitely does need changing, especially when you have the bank's, ability to do fractional reserve banking to create money out of thin air. One of my friends is a hedge fund manager, Chris Marchese, works with David Morgan of the Morgan Report, and he asked me to guess the total reserves that U.S. banks had in the system prior to the 2008 crash. Alasdair, their mandate, I think, is they were supposed to have, 10% of their reserves covered, right?
Well,
so they could do fractional reserve banking. That was what's written by law, but they had less than 0.05%.
Yeah,
during the crisis.
There are lots of exceptions in that fractional reserve system, and of course the other thing is that really what they're looking at is not the complete balance sheet. They're just looking at cover for deposits.
Yeah, so I mean they're figuring out loopholes around this so they can give themselves more bonuses, and it's just that the system is so inherently flawed with moral hazard. So you have the FDIC, where basically the banks can speculate with the depositors' money, and the governments will just print it up and give back the people's money. But then the banks can take enormous risk with that capital, and they can get a big bonus, and it's going to lead to inflation on the taxpayer.
Yeah, yes, I mean, I have to agree.
Yeah.
But, I mean, the problem basically is that we've got away from markets. There is no such thing as a market that works without enormous intervention anymore. And to some extent, if we don't have that intervention, some businesses are going to go bust because they cannot survive without the intervention. And and that now is really what the central banks most of the time are trying to prevent.
Yeah, unfortunately, and that's what we want. As Austrian school economists, we want companies to fail. You can't have capitalism, you can't have free markets without businesses also failing. I mean, that's the whole part of it, is they took too much risk, they took on too much debt, they misallocated their capital, they didn't hold enough cash in reserves, things like this. And you want the good firms to be more prudent, so then they could buy up the assets of the bad firms who took too much risk. But that's not really happening right now, because we have these artificially low interest rates that are suppressed by central banks due to, all the currency that they can create. And then it's leading to humongous distortions, like you said, in prices and markets. And we're just seeing like enormous amounts of leveraged buyouts right now. I don't know if you saw this, but we're seeing a humongous amount of billions of dollars worth of deals in the last 6 months or a year. For food companies and pharmaceutical companies, we're seeing humongous deals where the Chinese are coming in and buying up Smithfield Foods, or Brazilian companies with cheap capital are coming in and buying up like Hillshire Farms, and we're seeing humongous pharmaceutical companies buy that, and that's all because of inflation. So when in Europe we hear deflation, and yes, maybe credit's not growing, but I think there's clearly still inflation in Europe. We have a lot of listeners in Europe on our podcast, and they send us messages either in email or through social media, and they say, Jason, they say all this stuff. The rhetoric is, Europe's about to collapse, and it's horrible deflation. The banks are not lending, et cetera, but then they tell me in Germany and other places that, all their bills, their food bill, their electricity bill, consumer staple type of stuff, those bills are going up 7 to 10% per year, pretty much nonstop.
I think that's absolutely right. I mean, that's the experience in the UK. The problem with an index is that an index actually never reflects the reality of any individual's purchases and sales. It's something which is manufactured. It is something that, by definition, cannot evolve in the way an economy does, and it glosses over very important questions such as, where is the dividing line between immediate consumption and, let us say, the purchase of capital goods? I mean, you can buy things which could be in either role. Now, obviously, when it comes to a house, I buy a house, and to the degree that I don't get an income from letting rooms and so on and so forth, you could argue that I am actually consuming that house over a period of time. And so what's the cost of it? And self-evidently, the cost of property is rising in the UK quite rapidly. It's not quite, I think, what's happening in Europe, though I think there are some spots where they are rising, and certainly there's some spots, I think, in the US where prices are rising. Where's that reflected in any index that they take to either calculate inflation-linked bonds, or more importantly, to judge how the economy is going to deflate that GDP number? Because the GDP number does need to be deflated, and inevitably it's not deflated enough. And John Williams of Shadow Stats, who I must admit I haven't heard anyone mention for a little while, but he has done some wonderful work showing how the figures in the United States have been changed out of all recognition. And with those changes, you're just not deflating the GDP number enough. If you did deflate it by the correct amount, then it would actually be contracting in real terms year after year from 2008, if not before. So the figures, Jason, are a complete nonsense. They are not a reflection of reality at all. I see things going up. I see other things maybe not going up. But I am pretty certain that inflation in the UK is considerably greater than the 2-odd%, which is the Bank of England's target.
Yeah, I would agree. And I think basically every country in the world is in one degree or another of stagflation. So there's worse stagflation maybe in Japan or China, or some emerging markets, maybe countries that have U.S. dollar pegs the last few years, because they've had to print. When the U.S. did QE, they had to do their own QE to soak it up, a la currency wars and Jim Rickards. But in terms of the rest of the economy there. I think that's a good point that you brought up, is that there may not be consumer prices going up evenly with the Cantillon effect, because it's not going to be inflation is not going to be evenly distributed throughout the economy. But it seems to me that asset price inflation is the preferred type of inflation, at least for the wealth effect, for the bank balance sheets, for the hedge funds, for the economic and political elites in power, the people who can borrow, at zero and do the end carry trade and do all these crazy types of leveraged bets. That seems where the majority of the money and the profits have gone, since these QE programs began. For the most part, the money hasn't really trickled down to Main Street at all.
Well, and nor is it going to. I mean, you are right that the central banks take the view that a rising stock market is probably the best way to spread confidence throughout an economy. And that's one reason that they manipulate bond prices up by manipulating interest rates down. But no, you're right. It doesn't actually affect the retired, the pensioner, the person who, let's say, is on a fixed salary doing a fairly menial job. Let's say the 80+% of people, they don't get affected by a rising stock market. All they see is people lucky enough to make money out of stocks and shares, and they're unfortunate enough not to have the money to do it. Where is the justice in that, is the argument. And so I actually think that sort of manipulation by central banks, which they deem necessary, actually is socially divisive, or could be socially divisive.
Yeah, that's a very good point. And this QE, Alasdair, is making the rich richer. It's not going to the middle class in Europe. It's not going to the middle class in the United States. It's going really just to the top, 1% of 1%. It's going to the people who have the financial education like you and me, but they also have the asset and the collateral base to where they can borrow, $100 million at 0% or 0.1%, right? And they can borrow in yen, and they can do all these fancy trades that are with leverage bets and things like that. Or they can go and buy 10 houses here in the U.S. on, very little money down, and they could rent them out as rental properties and make an absolute killing on them. And this brings us to another interesting point. You brought it up before the interview. There's been an additional $20 trillion invested by global central banks to prop up global asset prices. Do you want to talk about that a little bit more?
Yeah, I think this is actually very important. It was the story was broken in the Financial Times today. This is an outfit called the Official Monetary and Financial Institutions Forum, which is actually being set up in London. They've been around for a little while, but basically they analyze what wealth funds, sovereign wealth funds and central banks are doing. And they have produced a report which is actually being launched tomorrow, so this is slightly ahead of the launch. But the Financial Times said the report identifies $29.1 trillion in market investments, including gold, held by 400 public sector institutions in 162 countries. Now, that is a staggering figure, 29.1 trillion. The total capitalization of all stock markets is about $65 trillion. So we're looking at a figure which is about 40% of that total. Now, I would assume that 29 trillion isn't all invested in listed stocks, but quite a lot of it has been going into listed stocks. And they have been saying, I mean, one of the interesting things that the Financial Times extracted from this is that China's State Administration of Foreign Exchange Fund, which is the world's largest public sector holder of equities, it manages $3.9 trillion, and it's part of the People's Bank of China. And I quote, "In a new development, it appears that PBOC itself has been directly buying minority equity stakes in important European companies." And the chapter on the report on Chinese foreign investment trend argues that SAFE's interest in Europe is strategic because it counters the monopoly power of the dollar and reflects Beijing's global financial ambitions. Now, that I find extremely interesting. So what we're saying, just to summarize, is that SAFE, which is only one of several Chinese sovereign funds, manages $4 trillion. I mean, this is a huge amount of money, and they're buying equities. They are also buying gold. Now, I know that they are buying gold, and what is interesting is that if you look at the numbers, 10% of that 3.9 trillion amounts to current prices around about 8,000 tons. So I'm not saying that they have gone and put 10% of it into gold, but if they are trying to pursue strategic objectives with their investment, then you can be absolutely certain that they're buying gold with part of that fund. So this to me is actually a major news story.
Yeah. I mean, you look at some of the purchases from some Chinese companies, and maybe they're getting financing from the China Investment Corp, which is the other sovereign wealth fund that China has, or the one that you mentioned, or maybe it's just the Chinese banks who have basically had to print as much money as the Federal Reserve has because they're on a dollar peg. So one of the dirty secrets that most people don't realize is that Japan and China have had to print as much money as the U.S. Fed has the last few years. They've actually outprinted the Fed. So they have an enormous amount of local currency going through their entire economy for a bunch of different things. But Alasdair, we're seeing Chinese companies come into the U.S. and they've bought Smithfield Foods. So they bought a humongous food company. We've seen them do a whole bunch of oil and natural gas deals lately. The last few years, they bought up shale oil positions. They just did that large natural gas deal with Russia. What I'm surprised with, though, is we have not seen the Chinese companies start to buy up 50% of some of these larger gold miners. I'm surprised they haven't started to, especially at these valuations and prices, started to buy, gold, proven and probable gold reserves in the ground at such a steep discount yet.
I think that does fit in very well with a strategic objective. The problem with gold in the ground is it's in someone else's ground unless it's in China. And, if things cut up rough in the gold market, then China could well find that their license, which they would have bought and paid money for, is revoked by a foreign government. So I think if I was advising China, I would say, well, if you get a good deal, then fine, consider it on its merits. But otherwise, this should not be a major priority. And I think that's broadly what they're doing, actually, when it comes to overseas acquisitions of gold. Now, having said that, they are working very closely with quite a number of mining entities in Africa because, you've got the copper belt in what was the old Nyasaland, and that's now Malawi and Zambia, and also in the Congo. There's cobalt, and there are all sorts of minerals and so on that they're getting out of there, and also to an extent, there's also gold. But I think they're pursuing that sort of, well, let's work with the government, let's buy the local government, if you like. I'll put it more bluntly.
Well, they're putting humongous infrastructure in, right? So
yeah.
They're not just putting the money right into the politicians' pockets, and the politicians, are not going to Swiss or the Caribbean. They're actually going into infrastructure for the whole local community. I think that's what I've read, right?
Well, I wouldn't like to comment how, whether the politicians are better off or not. Basically, if you're going to do business in Africa, it helps if you grease a few a few palms.
That helps almost everywhere, unfortunately, now.
I think the point I would really like to make, Jason, is that the way the Chinese do it is not they don't go in and buy sort of, let's say, a large Australian gold mine and then run that and have very little interest outside the gold mine and outside the employees. No, what they do is they will go into a country like Zambia or like Tanzania, and they will do a deal with the government, and they will provide infrastructure, and they will do a number of things. They will have people on the ground. In fact, they bring in a Chinese infrastructure to achieve whatever it is they want to achieve. But I think that's the preferred way of doing it, rather than, let us say, going and buying a company which has got a license to mine gold by the government as an act of parliament.
That's very interesting. Now, let's talk about a story that you broke. You were the first one in the gold community to talk about this, and then it went all through the blogosphere and all through the main newspapers. You talked about the Bank of England, how they sold 1,300 tons of gold in 2013, and that's one of the reasons why the price dropped so much. I remember that. That was around April, right, of last year. But the Bank of England doesn't own 1,300 tons of gold. So is that how much gold is probably required now to really knock the price down a lot and suppress the price and manipulate the market?
Well, let me just put it into context. You're right. The British government owns something like 300 tons, but the Bank of England acts as custodian for other central banks around the world, including obviously the UK Treasury Department. Now, I think, and all my observations support this idea, that they charge quite a lot of money for this facility. Now, if, as let's say, you're the Austrian Central Bank and you complain, well, you don't do anything about it, but the person from the Bank of England will say, well, there is a solution, of course, rather than your gold, and then you can actually put it to work and it can earn some interest for you. Oh, what a good idea, says the minor central bank, because after all, the Bank of England is a trusted counterparty. And I think that is the basis on which a lot of the gold leasing is done. It's done by central banks trying to not make their business profitable as such, but to ensure that they've got a sort of overall cap on their costs, including custody costs abroad, and they just want to see some income coming in to pay some of their bills. So that, I think, is the way the Bank of England works it. And so far, I mean, they really haven't had too much trouble persuading central banks. I think in 2014, as the indications I have had from central bankers is that they have come rather alive to the idea that, to the suggestion that it's not a good idea to lease out your gold because it is now going out in such large quantities that you can't cover it by newly mined gold coming in. In other words, the outflows into Asia to the new stock roughly and as a result, I think that in 2014, a lot of the minor central banks are tending to go a bit easy on the leasing. Now, there are major central banks who do have a problem, and amongst those I would list the Italians, the French, and the Spanish. Now, the and the French, I think, have got about 2,500 tons each. We never hear anything about this. The assumption is that they're just sitting on their gold. But on the other hand, when I look at the bond market rates, and I can see that both those countries are, Spain is borrowing at, I think at one stage it was less than 10-year bonds were yielding less than US 10-year treasuries, for goodness sake. I mean, talk about distortions. And I leasing of gold to pay some of the bills back at home in whether it's in Madrid or Rome or Paris might be part of the mix which is bond yields down. Now, if that is the case, then a lot of that gold is out on lease, and there could well be problems getting that back at the end of the day. So it's quite a difficult situation, I think, as far as when it comes to depositing gold in places like the Bank of England, which is the natural centre for them to deal in, because that's where the London, the London bullion market's the main market. But it's, I think the change is afoot. I just feel that.
That's a very interesting theory that these countries have leased out their gold, and that's why their borrowing costs are even lower than the U.S. I had never heard that one before. But in terms of,
I just hasten to add, I don't know. I'm speculating when I say that, but I think it is a reasonable line of argument, if you like.
It definitely makes some sense because, I mean, rationally, these countries should not be able to borrow for cheaper than the U.S., especially given the fact that their economies don't have Silicon Valley, don't have a shale oil boom. They're not getting manufacturing jobs back at the rate that the U.S. is because of cheaper energy and other things. And I think their taxes are also higher too, right?
Yes, no, you're absolutely right.
Yeah, so I mean, it's not like they're running, trade surpluses and budget surpluses, and that's why they should have low interest rates to borrow. So it's very interesting what's going on in that. But in terms of the gold market, I think you brought up something very interesting. When we look at Kuz Jensen's numbers of In Gold We Trust, we see that China is essentially buying up about 100% of the annual mining supply is going into China. And there's not really that much else gold for everyone else, at least in terms of the mining supply. So that gold is going to have to come from somewhere, probably Western central banks, right? And we're hearing reports that there is starting to be really old gold type of money that was used in the past as money that's going to Swiss refiners and Hong Kong refiners, right, to be melted down.
Yes, that's right. I mean, I speak to refiners and I speak to vaulting companies, and what you say is right. And I was in contact with one of the major refiners, Swiss refiners, earlier this month, and I asked him the question about demand because obviously, if you look at the Shanghai Gold Exchange numbers, they have fallen off somewhat in terms of sort of Chinese public demand. But he says, yes, they have fallen off a bit, but there is still considerably more demand than we can supply, and we're still having difficulty sourcing adequate quantities of gold. So, the imbalance between the demand for physical and, where it's actually. And as you know, there is only one place it can come from, assuming we rule positing it somewhere, and that is
or there's this Yamashita's gold hoard that some people are alleging. Yeah, it's like hidden in Hawaii in a vault or something like that.
Don't go there.
Okay, yeah, I won't.
But I mean, it is quite clear that monetary gold must still be being turned over. Now, what's interesting is that there was an analyst called Frank Veneroso, who is very highly respected, who gave a speech in Chile in 2002 about the level of gold being leased at that time, and he had come to the conclusion that a figure like 10,000, maybe more, tons in 2002 was actually out on lease. Now this is interesting because the total amount of central bank gold, tons. So what he's saying is that over a third of that time. Now, since then, we've had a bull market that's taken the price from, well, in 2002, it was around about $300 or something. Took it up to 1,920 at the peak. At that time, gold was hit hard by coordinated selling, which I guess would involve the central bank supplying leased gold. And also, we had the developments in 2013 when generated huge demand for physical bullion because people were very worried about leaving money in banks on deposit because of the new bail-in procedures, and they also were very worried about gold deposits, their unallocated accounts. And this led to ABN AMRO and Rabobank suspending the settlement of their gold accounts. They wrote to all their account holders and said, we can't do it. End of story. So there was in that smashdown, that smashdown in April was designed to get everybody to stop thinking gold was in a bull market. And indeed, in the investment community, that has succeeded. But of course, the cost of it has been it has unleashed unprecedented demand throughout Asia. And so you're talking about Western capital markets feeding gold to the middle classes of a population of something in the order of about 4 billion souls. That's what they're up against, and that was the mistake that they made. And I was also very interested when Ben Bernanke made his comments on gold. I think it was in August 2013 at one of the FOM. No, it wasn't an FOMC meeting. It was evidence before the Senate. And he said, I don't understand gold, and furthermore, I don't know anyone else who does either. Now, that I think was specifically as a result of their attempt to try and manipulate the price of gold down, that preceding April, which led, I believe, to the Bank of England supplying up to 1,300 tons, and how it just unleashed an extraordinary level of demand. And, of course, having gone down that route, they had to keep up with it. They couldn't suddenly withdraw, because what would have happened is they would have literally bust the whole of the bullion banking system. So
yeah, and it looks like that the system is headed towards a blow up, like what happened with the London gold pool, where they've basically come up with these new schemes either through Wall Street investment bank research or painting the tape on technical charts to just try and destroy sentiment here in the Western world, in Europe and the U.S. for gold. But it's just done the opposite in terms of demand for physical, where people in Asia, in China, in India, they're willing to pay premiums to get the physical metal because they see inflation in their own economies, especially in China and India. There's inflation all over the world, but inflation is even worse in the developing world, and they want the metal. So in terms of the Bank of International Settlements, you brought up the banks and them leasing and doing things like this and reneging on delivering unallocated metal or allocated metal in some cases. What type of role do you think the Bank of International Settlements, new Basel III, where I think physical metal is going to be Tier 1 capital, do you think then the banks are going to start to maybe buy physical gold and accumulate it then because of this?
I think central banks will look at rebuilding their position. I think you've got a very interesting position with the Bundesbank, who have apparently, I think it was about 1,530 tons held by the New York Fed, or at least it should be there. And the only settlement they can get is to tons of it sent back to Frankfurt, I think, over a period of something like 7 or 8 years. And in year one, given that this was an agreement which was struck in January 2013, in year one, they only got 5 tons back. I mean, that's telling us, I think, that the gold isn't there. Germany's gold is gone. Now, I think, if I was I was manipulating the gold price, and there were people like, Macleod and Burrick sort of saying, well, obviously the gold isn't there. That's the risk. What I would do is I would have at least got more than 5 tons out to try and persuade the markets that there isn't a problem. But, I mean, this is just complete nonsense. So, I think there's a blow-up coming up. There must be a blow-up coming up, because how do the central banks explain to the politicians, if you like, people being very interested in this in diverse places, from Switzerland to Austria to Germany to Finland to Sweden? How do you explain to them, I'm sorry, the gold's gone, we don't have it anymore? I mean, that's a very, very difficult conversation to have, and I think that's what they're fencing around.
Well, then you start going through the Keynesian spiel then of how gold's a barbarous relic and it's not really good for us anymore anyway. But I think the German Keynesians, the people in the central bank of the German central bank who are Keynesians, they don't want the gold back, Alasdair. They want to keep that gold either in London or in the New York Fed, and they want that gold to help manipulate the price. At least that's what the declassified government documents that have come out. I interviewed Nomi Prince, who wrote the book All the President's Bankers, and she was talking about in an interview recently that I did with her how there was a humongous amount of correspondence between American presidents and American central bankers and German central bankers, in the 60s and 70s, how to manipulate the gold price with the London gold pool and things like this, and how they don't care about, they don't want the gold price going too high and things like that.
Well, that undoubtedly is true, but I think you've got to look at it from the Bundesbank view. The Bundesbank basically have always been sound money advocates. That was apart from anything else, their fathers and grandfathers have been through complete currency collapses. Firstly, after the First World War in the early 1920s, and then there was a a complete collapse when Germany lost the war in 1944. So they understand the difference between unsound money and sound money. I think that's a point worth making. They live in a real world, and the real world is one where the dollar is the reserve currency and gold is no longer exchanged for currency on any official basis whatsoever. Now, so they have to deal with not the world as they would like it, but the world as it is. And I think that did place them in a very difficult position. Now, of course, the Bundesbank is in a completely different situation, because the relationship, if you like, the top table of monetary manipulation from the European end, of course, is the ECB. So, the Bundesbank is relegated to the same as the Bank of Austria, the same as the Bank of Portugal, and the same as the Bank of Greece. They are now a sort of one tier down. They're not at that top table anymore, running the world's monetary affairs. And I think that that's actually something which is quite difficult to live with. And I think if I was a German central banker, I think that would probably absolve me from quite a lot of the things that I didn't like in the past, and I think I would probably stand my ground a little more. And what's interesting in this is BaFin, the bank regulator, has decided to go for Deutsche Bank over its gold dealings. Now, I would venture to suggest that if the Bundesbank was at the top table, I think you'd probably find there would be a conversation between the Bank of England, at the very least, if not the Bank of International Settlements, and the Bundesbank about this could get out of control. Can you please tell BaFin to back off? Now, I mean, I just don't see that the lines of communication are there whereby the Bundesbank can actually, or is even interested in telling an independent German regulator, banking regulator, to back off examining Deutsche Bank's role in the fixing in London, whether they've been involved with foreign exchange manipulation, so on and so forth. So, to my mind, it's a very different world, and it's a world which I think could well come back and bite the Fed and the BIS. So it's not a simple situation anymore, Jason.
Yeah, I definitely agree, and I think they're running out of physical metal to keep the price suppressed because, in order to do this hypothecation and to have the fractional reserve bullion system that has been done on the COMEX and over-the-counter derivatives and on the LBMA, you still have to have metal. But the problem is the metal is coming out of that system, and it's going into vaults outside the system, people who don't trust the system anymore. And it's only a matter of time before there's so much metal taken out of the system. I really think things accelerated around 2010, 2011. I think the Chinese were involved in actually helping knock the price back down in 2011 because they said, hey, wait a minute, gold's already at 1900. Obviously the Fed and Wall Street, the bullion banks, didn't want the price that high to begin with. But then the Chinese came in and additionally and said, we don't have enough metal yet. So we need the price knocked back down further, and I think that's what's happened. But we're to the point now, Alasdair, where the Western central banks are running out of gold that they can lease into the market, like you said, or actually, outright sell. The Sprott did a interesting piece on showing the trade data for the U.S. that the U.S. has actually sold a lot of physical gold. And then we have a situation here where the miners. So there's really a humongous percentage of primary gold and silver miners. They're running at big losses. I think if I could just interject, I think when it comes to China's strategy in the bullion markets, I don't think they interfere in the pricing at all. I think they're just clever buyers. I think that when they see stock offered, they take it. I don't think they manipulate the price. They understand what the situation is. They don't want to get caught manipulating anything. That's not their style. I think the mistakes that have been made are entirely the West's. And yes, China's benefited from it, but I really don't think that China's in there manipulating the price. I think she's benefited hugely, but we've been stupid enough, I think, in following fiat money policy of trying to ensure that the dollar remains as a reserve currency
it, which is really what this is about. I think that we've made huge, great mistakes, and it has led to a massive transfer of wealth, in effect.
Well, they don't see it as mistakes, Alasdair. The people in power, the Keynesians and the other people who are basically like a lot of people in power here in U.S. and Europe are essentially Marxists. They see it as that they're kicking the can down the road. They're keeping themselves in power until they figure out some other type of scheme or something like that to, increase taxes or some other type of thing that hurts I really think, unfortunately, that the goal of this central planning has been to socially engineer a different type of utopia that they want and to basically destroy the middle class, or reform it into however they want, where people who don't have that many assets, who don't have that much, can barely pay their bills and things like that. And, basically where the people at the top just they're rent seekers, so they just funnel off, more assets and more cash and more other things from the hard work and productivity of people on Main Street on the entrepreneur class.
Maybe.
Well, I have one more question here. It's for Chinese gold demand. How many tons of gold do you think China has? And you recently also came out with an interesting article with research on it, saying that the Chinese demand is actually been much larger than Jansen's projected numbers, which was around 100% of annual mining supply. Can you talk a little bit about that, why you think Chinese gold demand is even more than Jansen's numbers?
Yeah, I can. I think the first thing we have to appreciate is that the numbers that are provided by any government, and the SGE is a government department, are entirely suspect. I mean, we've seen that with literally government. And if the Chinese government's gold figures are accurate, then it's, first of all, it's the only figures that come out of China that are accurate, which I find hard to believe. If they can get that one right, why can't they get the other things right? So I have this feeling that we're being told only part of the story. There is another thing. I mean, we're in the business of at Gold Money of bring bullion for our customers, and we have vaulting facilities in Hong Kong. We deal with the major refiners, and one of the great mysteries in all this is that neither the vaulters nor the refiners have ever seen Chinese 1 kilo bars refined from a Chinese refiner. They're never seen in the market. Now, admittedly, there are fairly strong the borders to try and stop people smuggling gold out. But I think something like 300 tons went from China, and I assume that came out of the SGE, into Hong Kong, where presumably a lot of it was refabricated to be sold back into China in the form of fabricated jewelry. But I mean, the point is that, you can get a license to go and buy gold from the Shanghai Gold Exchange and then take it into Hong Kong to do what you want with it. So why is it that there are no 1 kilo bars from a Chinese refinery ever seen in Hong Kong or indeed anywhere else in the West? I'm not talking about the smaller bars, because there are retail bars that they produce. I think there's a 50 and 100 gram which they trade on the SGE. But these 1 kilo bars are never seen. And there can only be one answer, and that is that the Chinese government itself takes all those bars. Now, we're talking about not only her own mine production, which last year was a short 430 tons, but we're also talking about all the scrap that's recycled. Now, scrap basically are bars that are delivered out of the vaults and then returned, if you like, into the market. Before they're returned into the market and can be sold in the market, they've got to be re-refined. Guess how? By being sent to a Chinese refiner. So I don't know what the figures are, but if someone told me that the scrap being refined in 2013 was a figure like 300 or 350 tons, I would think that's probably right. So if you take that 300 to 350 tons and add it to the 430, I mean, that immediately is another sort of 700 tons, 750 tons maybe, which is not being accounted for at all. Nor are we given any figures for what the PBOC might buy for itself. It doesn't necessarily go through the Shanghai Gold Exchange. So there again, there could be substantial imports. And this is why I think that this thing from the FT today, from OMFIF, is really of great interest. And that is, they say that SAFE manages $3.9 trillion, and it's investing it in equities. And if the strategy for them investing in equities is right, then they're also buying gold, and they will be buying it in big quantities. And 10% of $3.9 trillion is 8,000 tons of gold. So you can see that there is a lot of activity there which isn't captured in the figures. And I was trying to some of that insofar as I could see it. And I think that's probably where Koos's figures differ from mine, because I think he works on the figures as they're presented, which actually is, I mean, I think he does a fantastic job doing that. I've got a different approach, and that is I look at it from a top-down, a complete top-down, and I don't take the figures that are given by any government department as gospel. And I fit in terms of strategy and the broader flows. I mean, for example, I was talking to a Swiss fund manager today in the gold market, and he was saying that over 3,000 tons had been imported into Switzerland, and only 300 tons of that remained in Switzerland. And what people don't know is that excluded from that is gold that is imported into Switzerland but remains in the free trade area. So you're talking about huge quantities of gold going into Switzerland, which are then re-refined and then sent out to Asia. Now that's 3,000 tons. I think I'm right in saying that the Chinese demand was only that only came out something like 2,200 tons last year, and a lot of that gold self-evidently came from elsewhere, like America, like from the Rand refinery in South Africa, various other sources. So.
Jim Rickard said that China single-handedly bought like 500 tons from the Perth Mint, and that he helped facilitate that. I think Jim Rickard said that recently.
Yeah. So, well, I didn't hear that, but that wouldn't surprise me at all.
And Jim Rickard's also said in his book, Alasdair, that the Chinese military is also secretly like buying, is helping do these gold deals and moving humongous tonnage of gold into China through secret, deals and on different borders.
Well, there you are. He's more of authority on this than me. I just look at it from the geopolitical bit, which I know he does as well. He will be better informed than me. But I'm coming to the same sort of conclusion, completely independently of anything that he's doing.
And that's a good point about the government statistics. I mean, we look at GDP, we look at employment numbers, we look at the inflation statistics. So we shouldn't trust. Based off that, at least, we shouldn't trust then these gold numbers are 100% accurate as well.
Well,
but they're
yes.
probably underestimating.
I would add, and this is a point about this OMFIF thing, that banks around the world and allied funds have put 29.1 trillion into market investments, including gold. This is staggering. I mean, if I'd written an article a week ago saying that, the Fed has been buying equities, well, where's your evidence? I haven't got any evidence. Of course I haven't got any evidence. But, I wouldn't have dreamed a figure like 29.1 trillion into market investments, including gold. Full capitalization of the global equity market is only 65 trillion. This is staggering intervention.
And this is only in the last few years, right? This is.
Well, I mean, presumably there's always been a position, but of course, we're never told this. But there wouldn't have been much of a position, I would have thought, before the Lehman crisis. And I would have thought that these positions would have built up really in post-Lehman intervention, which, as we know, has been quite major.
Exactly. Really, since the Lehman crisis, and Lehman was used as essentially, I guess, a sacrificial lamb Obviously we want banks to fail. We want free market forces, but the people that are in power, the Keynesian central planners, Keynesian central bankers, the politicians, they've decided they really don't want free market forces in the banking system anymore, and that they want to prop things up. And the banks have actually gotten too big. They've actually gotten even bigger since 2008. That's the scary part. They've gotten bigger, and their derivatives book has gotten even larger, and they've gotten they've gotten bigger than most governments.
Yes, I know. It's quite terrifying, isn't it?
Exactly. Well, I think we're going to wrap things up on that, Alasdair. It's been a very interesting hour or so on our chat. Can you please tell our listeners more about your work and where to find it?
Yes, I write mostly for Gold Money. So if you go to goldmoney.com, you'll find I do a weekly market report and also a weekly article, which is usually on either economics or precious metals. And I have my own website too, which is financeandeconomics.org. But most of the time that's really replicating what I write for Gold Money. Just occasionally, if I write something which isn't suitable for Gold Money, then I might publish it on financeandeconomics.org.
Very good. Well, thank you again for your time, and hopefully we'll have you back on again soon, and maybe I'll be able to convince you to come on with Kuz Jansen and do a roundtable.
Anyway, thanks very much for interviewing me.